Greetings, my friends, and welcome back to our channel. Today, we're diving into one of the most important correction documents in accounting, the credit note. These handy documents reverse or reduce a previous invoice, and if you've ever returned goods or been overcharged, you've already dealt with one. In this video, we'll break down what credit notes are, how they work, and how UK accountants record them. A credit note is basically a negative invoice. An invoice says the customer owes the seller money. A credit note says the seller is reducing that amount. It is always issued by the seller. Credit notes are used when goods are returned or rejected, when a price was wrong or an overcharge happened, when goods are damaged or faulty, when a discount is applied after invoicing, or when an order is canceled. The purpose is simple: correct the original invoice while keeping a clear audit trail. Credit notes exist because proper accounting does not allow deleting or altering original records. Double entry bookkeeping requires corrections, not erasures. A credit note formally reverses part or all of a sale. It keeps the history clean and allows accurate VAT reporting. A valid UK credit note must clearly show the words credit note. It must have a unique credit note number, the issue date, the seller's name and address and VAT number if registered, and the buyer's details. It must refer to the original invoice number. It must describe the goods or services being credited along with the quantity, the unit price, the net amount, the VAT amount using the same VAT rate as the original invoice, and the total credit value. It should also state the reason for the credit. Businesses should use sequential numbering for control and audit purposes. A customer buys 100 units at £10 each. The net total is £1,000. VAT at 20% is £200. The total invoice is £1,200. 20 units turn out to be defective. The seller issues a credit note for those 20 units. That is £200 net plus £40 VAT, making a total credit of £240. The customer now owes £960 instead of £1,200. The credit can reduce the original invoice, it can be refunded as cash, or it can remain as a credit on the customer's account. For the seller, the accounting entries are normally debit sales returns for the net amount, debit VAT output for the VAT amount, and credit accounts receivable for the total credit value. For the buyer, the entries are usually debit accounts payable, credit purchase returns, and credit VAT input. These entries reverse the original transaction in proportion to the amount being credited. When a return, a refund, or a price reduction occurs, the seller must issue a credit note promptly. The VAT adjustment must be included in the VAT period in which the credit note is issued, not the period of the original sale. The VAT rate on the credit note must match the VAT rate that was used on the original invoice. Credit notes support VAT accuracy during audits and compliance checks. In the United Kingdom, accounting records must normally be kept for 6 years. Credit notes must be stored together with the related invoices and all supporting evidence. This includes emails, proof of returns, photographs, delivery notes, and internal approvals. A credit note reduces what the buyer owes. A debit note is usually a buyer's request asking the seller to issue a credit note. In the UK, debit notes are not used very often. Most sellers prefer to issue credit notes or supplementary invoices. A credit note is also different from a refund receipt. A refund receipt simply proves that cash has been repaid. A credit note adjusts the accounting balance.
Finally, you must never edit or delete an invoice that has already been issued. A credit note is the proper legal method to correct it.
Common mistakes include not referencing the original invoice, using the wrong VAT rate compared with the original invoice, issuing the credit note too late, failing to document the reason for the credit, using duplicate or non-sequential numbers, and issuing credits without proper authorization. Clean documentation prevents disputes and audit issues.
Different industries use credit notes in different ways. Retail uses them frequently for returns. Wholesale uses them for damaged batches, shortages, and pricing errors. Professional services use them for canceled work or time corrections. Manufacturing uses them for defective product returns and warranty adjustments. Software and subscription services use them for prorated service credits and cancellations. Modern accounting software automates numbering, VAT calculations, invoice linking, and ledger posting. Always issue credit notes quickly. Keep the format professional and consistent with your invoices. Set approval limits for high-value credits. Review credit note patterns monthly to identify pricing errors, product issues, or staff training needs. Buyers should file credit notes immediately and reconcile them against supplier statements. Credit notes are more than just paperwork. They keep your accounts accurate, ensure VAT is handled correctly, and protect both your business and your customers. They're the backbone of clean accounting and strong audit trails. Thanks for joining me today. If you found this helpful, don't forget to like, subscribe, and stay tuned for more practical tips to make accounting simple and stress-free.